euro. Philippe D'Arvisenet, Chief Global Economist at BNP Paribas, joins me now. Philippe, thank you so much for coming in today. Now, what we understand from the weekend is that there is the strongest message, that there is a political will to keep the eurozone together, that they are willing to be a lot more flexible on the bailout terms for Greece. But at the end of the day, well, the yields are still at 23% for the 2-year. How is this nation going to get back on its feet?
Well, something was obvious, that meeting had to take place, if not yesterday, in 2 weeks, 3 weeks, whatever, because what is sure is, as you mentioned, yields are somewhere on the roof. And on the other end, they have to tap the market next year because the money coming from the bailout is not enough. They have to tap the market for 30 billion, something like that. It's impossible with these yields. So something had to be done. And it happened maybe a bit earlier than expected.
But we talk a lot about, the political will, and Europe wants to keep these nations together. It wants to keep everyone in the euro. But how far can they go? Because we talk about this every 3 months. The strongest message yet from the eurozone, the strongest message yet from this country or this country. What can they do concretely?
Oh, every economist know what to do. I mean, we knew from the start that the euro was not badly well shaped. In a sense, you have a unique monetary policy and no fiscal federalism. That's obvious. When there is a crisis, a fiscal crisis, and they come, the politicians, saying, well, maybe we should set up a competitiveness plan. I wouldn't say they are behind the curve. They are off the curve. So everybody knows what to do. There is not a political will, or not enough yet, or not enough crisis yet, to implement this sort of thing.
I like that. Not enough crisis yet. What is it going to take to have that political will? Are we going to have a country saying, I want to leave the euro?
There is some kind of, to be honest, there is some fiscal federalism coming by the back door, creeping in, if you will. There is a kind of debt federalism. You have a country with a problem. You bail out, you give liquidity. There is a solvency problem that requires more solidarity. It could take the form of a Eurobond, if a European issuing agency on behalf of governments, whatever, but more fiscal federalism. It takes a lot of time because, they are behind the curve. And on countries themselves, it happens that I was in Greece last week. I met a lot of people, not just clients, but also officials, not politicians, the level below, I would say.
The guys that actually get the stuff done.
And these guys are a bit, they feel the same, saying that, okay, it's very easy to cut expenditure. You decide minus 5% on civil servants, okay? When it comes to collect taxes is another story because you have to fight the lobbies you have been friendly with for 20 years, and that's much more difficult.
But in terms of, we had a report on Friday saying that actually Greece is thinking about exiting the eurozone. Was that a bargaining chip, or do some countries in Greece, why not actually leave the eurozone default, like Argentina? They'd be in a stronger position in a couple of years.
Well, I don't believe in that for a simple reason, which is first, Argentina devalued, went back to its old currency, not just the dollar, devalued, then you devalue, you gain competitiveness, you explode, you know the story. On the other hand, you need to have access to the market, otherwise you are, just with Argentina, 25% recession over 1 year. You spend 100, you receive 90. Nobody wants to lend to you. You have to spend 90.
But with yields at 23%, you can say that it's arguable.
So you exit. You have a banking sector of Greece, which is full up with Greek bonds. That collapses. There is no money in the Greek government to save them. On the other hand, and that's why I don't believe in default, who is the creditor? German banks. Not only Germans, but German banks. Well, the interesting thing is the Germans say, well, we want the private sector involved. That is the banks, mutual funds, infrastructure. The private sector in Germany is German banks that are mostly public. This is very curious.
But what I fail to understand actually is that when I started in this business, it's always said, it's better to take losses now than just make it drag on for 1 year, 2 years, 3 years. And that was true for company results, for anything. You take the provisions now and then move on. What about, do we not need a restructuring at some point?
When you are a politician, your horizon is not very long. Your horizon is a few months from now because you will have elections somewhere. So you are always behind the facts. And the measures, if the measures had been taken, we have a problem with a few countries. Let's take measures that address these countries and not one by one, Greece, then Portugal, then this, then that. Always it doesn't make sense. It feeds the volatility, the fear of the markets, of whatever. This is what happens.
Are we going to have a similar problem with Ireland, or are other countries going to look at this renegotiation of a bailout in Greece, hoping that they themselves would get better deals?
Okay, Ireland, they have an interest rates with this public money, which is a bit higher than the others because there is a bargaining thing. Okay, we will be more friendly with you, provided that you abandon this 12.5% tax, corporate tax, for something higher. Okay, on the other hand, you can think also, well, these guys, in order to come out from that crisis, they need some growth. This is a way to have growth. Maybe tax competitiveness is not something that bad at the end of the day. It exerts a downward pressure on government, on expenditure, I should say. Maybe some countries should also enjoy this. They don't. They want the others to increase their taxes, so in order they keep buying votes at home.
It's true, and it's a problem that will continue unless they resolve it some way or the other. In terms of what it means for investors, are we going to see a relief in the euro? Is it going to edge up slightly because we see this very strong political will of the European officials to keep the bloc together?
Yeah. What I mean, it doesn't make sense to have the euro bursting these days. I mean, you have a crisis which is impacting not even 5% of the European GDP. The rest is growing quite appropriately when you look at the growth that will be released in Germany, France, etc., the market indices, the PMIs, etc. I mean, the recovery is there. There is a problem which is of a limited size. We have to deal with politicians, unfortunately, once again. There were stories, a two-tier eurozone, an exit of Germany, etc. You remember that
we've looked at all the possibilities.
Plenty of scenarios like that. Take the last one. Germany is exporting 50% of its stuff in Euroland. It would mean an appreciation of its currency, not to speak about the banking sector we talked already about. If you speak to any kind of employers association, I don't remember the name in Germany, the CBI in England, if you will. I mean, these guys are not against the euro. They know that appreciating a currency would put at stake, would offset, I would say, the consequences of the effort that they have made during 10 years in tightening their belts, wages, etc. So it's not worth it.
Philippe, in really 20 seconds, are we going to see a restructuring of Greece in the next 2 years, or no way?
No way. No way. It's because of the fear of a contagion. I mean, the cost would be more important than the short-term nice impact, if you will.
Yeah. Philippe, thank you so much. Philippe D'Arvisenet there from BNP Paribas.